Much. Okay, let me share my screen. And gentlemen, ladies, please do let me know once you can start seeing my screen. Is everybody able to see my screen?
Yes, yes.
Good morning, gentlemen and ladies. A very warm welcome from me to all of you. Thank you for starting your day with me and evening in case of Canada. Well, Yoga has already given a brief introduction about who I am, but I'm going to take this 10 seconds to give you a helicopter eagle eye perspective of who I am, what I do, which is I've been in research and consulting space for a little about 20 odd years. I've been a serial entrepreneur, mentor, advisor, and board member to several startups and business owners. I'm able to do this predominantly thanks to my last experience, which is as ex-founding employee of a company called Insight Alpha, which is in a business that only about a dozen companies globally operate in. That's essentially matchmaking organizations that seek knowledge with people that have knowledge. They do this leveraging on a network of ex-ministers, former politicians, bureaucrats, army generals, the top C-suite brass, upper echelons, head honchos, that is your chairmans, board of directors, advisors, country heads, presidents, what have you, in more than 40, 50,000 companies globally across 80 countries at a bare minimum. A new expert of this stature and rank joining the network about 10 minutes. A conversation brokered between knowledge seekers and providers every 5 minutes. Clients include who's who of the investor world, about a few thousand in count, and in terms of the assets they manage is about 4.38 trillion. Prior to that, I was an ex-HR for a Fortune 500 company whose annual revenues in the range of 3 billion. I've been an ex-events director, organized 100 plus events in a time and a period when industry wasn't as extrapolated as it is today. So I'm using the juice of all of this experience to today help companies across sectors and geographies to do all that Yoga had already highlighted. Before I actually talk about how the investor world works, here's a little fact sheet that I sort of thought was helpful to, know where we stand in terms of, we as individuals versus the other entrepreneurs and business owners. There are about 6,000 thoughts that any individual gets every single day. Multiply that with an 8 billion population, or even half of it, which is the working age between 25 to 60 years. There are about 50 billion thoughts that are generated every minute. And mind you, about 500 million entrepreneurs exist already. Twice of that is the amount of population that is skilled enough to become an entrepreneur, all in a matter of time and interest and place and so on and so forth. Compared to these numbers, there are only about 1 million HNIs, ultra HNIs that exist globally, which is approximately about 5,000 per country, give or take. So in summary, at any given point of time, any business owner, entrepreneur that is trying to raise capital, whether the first time or a subsequent time, you're competing with at least 500 others. So it's very important that the laborious task that you're entering while raising money from any institutional investor, that you make sure that the person, the entity that you're approaching is the right match for you, so that you don't end up wasting your time, effort, and of course the cost of opportunity attached. So let me drill down the investor scale for you. First and foremost, they're not alike. You may think so. I'm going to break some old beliefs there, but all investors are not same. There's no one size that fits all. They have limitations and bosses too. Who their bosses are, we'll get to that in about 30 seconds, but they have agreements with these bosses, which they have to strictly honor, as part of which they can only invest specifically and selectively in certain sectors, in certain amounts, in certain geographies, in certain number of companies, and permutations and combinations of all of the above. If I have to categorize broadly, investors could be categorized in two, which is retail and institutional. Retail meaning the 3F, which is your friends and families who invest, give you that first seed capital for you to start your business. Angel investors are basically individuals who have a certain wealth thanks to their professional experience, the high fatty check salaries that they have drawn in their experience. And instead of investing in stocks, they choose to invest in a particular company they feel has a merit or a future. because these are individuals, hence the retail term. On an institutional side, there are two categories. There's venture capital, which, as the name suggests, they invest in ventures, startups. However, in comparison with angel investors who could also invest in a idea or in a company which does not have a minimum viability product or a proof of concept, a VC would invest in a company which has at least a couple of MVPs and POCs. Private equity, by that degree, invest in companies that are not startups but are in an early stage, which means they've been in the business for some time, and it all boils down to the size of investment that you seek. Obviously, a 3F or an angel investor maxes out at a few million. A private equity, depending on the size of a fund it is, whether they're managing an AUM of few millions to a billion, they could invest only by that degree. So we talked about the bosses of investors, right? So in the investor terminology, they're called as LPs, which is limited partners. These are, again, from retail perspective, these are high net worth individuals, ultra high net worth individuals. From an institutional perspective, these are endowments, family offices meaning, again, HNIs and ultra HNIs who've set aside an office, which is in the business of investing, trading, treasury, stocks, and what have you. Fund of funds are basically in the business of giving money to the investors. Let me go back to the previous slide and give this a little more clarity. Angel investors and 3Fs invest their own money in your business, whereas VCs and private equities do not invest their own money. They raise money from LPs, which is then further invested in your business. So they generally have a 3, 5, 7-year agreement with LPs in which they claim to return the money at least 3, 5, 7, 10, 16, depending on the times of agreement that they've had, back to the LPs. This circle viciously continues to continue for a reason, when they're done with one fund, they raise another fund, and that's how life goes on. GPs is a terminology given to all investment companies, general partners. So GPs raise money from LPs, business owners raise money from GPs, which is segregated into two parts, depending on whether they invest in private companies or public companies, is how legally, operatively they are structured. So most private companies raise money generally from PEs and VCs. However, there are also sovereign wealth fund, which is the government's money of any country that's invested in public and private companies. The difference between PE VCs being PE VCs only invest in private companies, whereas a sovereign wealth fund would invest in both public and private companies. By that degree, there are public funds, which is hedge funds that only invest in companies that are public, listed on stock exchanges. Same goes for mutual funds. DAF is a distressed asset fund, which is basically a fund that invests in companies that are bleeding losses, non-performing assets. So the reason they still decide to invest is because they get the company at a cheaper price and they claim to turn it around so they can still make money out of it. I won't get into the details of other categories because considering the audience, most of us are in private businesses. Like I said, SWF is sovereign wealth fund, distressed asset funds. Some can invest only in specific and select type. PIPE is a private investment into a public equity. Mezzanine is a fund set up between two funds, and fund of funds are LPs who give money to GPs. Now, there are most common pitfalls, and this comes from a place of experience of having sat down with these institutional investors day after day, week after week, month after month, seen proposals after proposals of how the business owners present and pitch their ideas to these investors. So crux of all of that has led me to state this with fact that these are some of the most common pitfalls that business owners tend to fall into. Number one of them being emotional attachment with the business, as a result of which they hold their cards close to the chest. I have this question and I leave it to you to ponder. What would you rather prefer? 100% stake ownership of a company whose value is 1 million, or 1% ownership of a company whose value is 100 billion? So there are more often than not resistances to change and hence no exit plan. As an investor, it is important to them that if things go south, Are you planning to exit? Are you willing to exit? Are you willing to sell your stake in the organization? Because what they're concerned with is their money invested in your enterprise, which again, mind you, if you go back to previous slides, is not their money. They also have to return. They have the bosses too. So come what may, you need to have an exit plan. It could be strategic, which means you may end up being bought by another company of a larger size in your sector, or another investor willing to take away the existing investor's stake so that they can exit. So exits are as important to them as entry. Another common pitfall that I've seen most business owners being enamored by is trying to build the next wonder in the world while it may already exist. So, they end up spending so much time in building that by the time that they've built it, sometimes there are no visitors left and they're trying to re-engineer the wheel. And there is a humongous amount of time, efforts, and cash that they lose, which could otherwise have been spent in building their go-to-market strategy, a basic minimum viability product, a proof of concept, and vis-a-vis cash flows. That is imperative, especially in the formative years of any business. It's the oxygen for survival. And while they're building that, they deny raising funds. And what happens is somebody else, because there's no barrier to entry in any business, right? Their competitor ends up raising the same fund and grows faster than them and shuts them down. And there are enough stories to prove around this. A couple of examples. Look at how LinkedIn's website looked when it was launched. Look at how Amazon's website looked when it was launched. It wasn't as pretty as fancy as it stands today, but they did still decided to launch it anyway. And you learn on the go. Another pitfall that we've seen is inaccurate valuation of the company and its equity. Sometimes the business owners, because they want the right people to join the team, they want to raise money too quickly, too fast, too early, too soon, they end up distributing equity like pancakes among the founding team and the first investor. Because the investor is coming in with money, they tend to negotiate and arm twist the business owners, who either because of lack of understanding the investment world or the lack of understanding the equity valuation, the rightness of it, end up giving up more equity than they should. The opposite is also true, because I said, some of the business owners are sentimentally attached to their businesses, so they're overprotective about the equity. As a result of which, they continue to be in this vicious circle of negotiation almost perpetually with the investors. And just excuse me 1 second. And as a result, they end up never raising a fund, because they continue to talk to more and more investors, and eventually the word spreads like a jungle fire, and investor world operates very close knit to each other, hand in gloves, and hence also get blacklisted by some of the potential suitors, and they're put in a do not approach list forever. So the time when they're actually ready to share the equity, guess what? The investors already have a perception and image. There's only so many chances that you get in front of them. Same is also true when they have too many preferences, that we want an investor of A, B, C, D, E types. They have too many filters. And as it happens to any platform, any search engine, when you put in too many filters, you generally get no results found. So to sum up, it's imperative that you should know who your investor is. Couple of ways how you could do that is, whosoever that you're approaching, right? They obviously have a website at a bare minimum. And most investments once made are generally public. And because even investors, GPs, have to raise money from LPs for the next round. So their way of getting testimonials and success stories to their bosses is by listing all those investments that they made that eventually became successful. So you could find this on their website, even you could Google, all of this information is in the public domain, more or less. So whosoever that you're trying to approach, make sure you know what kind of sectors that they've invested in past and in recent. And this keeps on changing. Maybe the last fund that they raised was in an agreement that they could only invest in healthcare sector in Dubai, or maybe technology in Abu Dhabi, or hotel industry in Kuwait, and what have you. But that may have changed from the next fund, because the next fund LP said, okay, you know what, I'm more inclined towards education. So now you can only invest in education. So you need to know both the past as well as the recent because with every fund that they raise, the priorities, the preferences of their LPs change. You may, however, not get to know what the LP mix is, but what you can definitely figure out is what kind of investments have they made, which sectors, and same but for geographies. And also the amount, like I said, it's a public information. So you can know the standard sweet spot of amount that they generally tend to invest in, which will help you understand if you're looking for 10 million and all their investments are in the range of 30 million and above. It's futile for you to approach them because they wouldn't even look at a company if you're looking at anything less than 30 million. The opposite's true as well. You may be looking to raise 30, but their average investment is about 10 million. So they will never be able to capacitate an investment of that size. So know their fund size. Like I said, the website is informative enough, and you can also find this information on Google in different ways to find out what is the size of the fund. So say a private equity says that we have 100 million under assets under management. And if you look in the past that they may have invested in 7 companies over the last 7 years, which means on an average, they can invest about 15 million. And if that's the size of investment that they've already made and they've already invested in 7 companies, guess what? They've already done with their quota for this particular fund. Now, not unless they raise another fund from another LP, they're not able to invest in your company because they've used the quota, they've used the amount that it was there available to be invested. So even though they're the right investor, they're investing in your sector, they're running a big fund size, but they've already done with the quota. So it's futile for you to, at this given point of time, approach them. One last degree by which I would segregate investors is strategic versus financial, which is in simple terms, a financial investor is an investor that comes purely for the purpose of money. All they are concerned with is ROI, the IRR, which is the investment rate of return. That's generally between 16 to 20 times of the money that they invest in 3, 5, or 7 years, depending on the term sheet agreed. Strategic are corporates, which have an investment arm that always has an eye out for joint ventures, merger acquisitions. So they continue to acquire more and more companies or merge with them or joint venture with them. But because they are from your sector, they have hands-on technical knowledge about the same business that you do. They are the leaders usually in your market. So for example, let's say if you're a technology company providing antivirus solutions, so your strategic investor by that example would be say McAfee, Kaspersky, and Avast. If you're a telecom company producing mobile handsets, by that degree, your strategic investor would be Apple, Samsung, and what have you. Thank you. Open the floor to questions.
Thank you very much, Abhishek,
No
for coming
problem.
here and sharing your knowledge with us. And before I open the floor for question, I'd like to give this certificate of appreciation to you.
Thank you so much, Yoga.
So I will send this to you by email.
Sure. Thank you so much.